On Wednesday, U.S. Federal Reserve raised interest rates by 0.75 percentage points for the second time in a row in an effort to rein in run rate inflation without triggering a recession. The movements in June and July raised the benchmark overnight borrowing rate to a range of 2.25 to 2.5%, marking the most rigorous consecutive action since the Fed started using the overnight funds rate as its primary tool of monetary policy in the early 1990s.
Strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet.
All right, for more on these headlines, we're joined by Efosa Aluyi, who's the head of investments at Sankore Global Investments. Efosa, good morning to you. Thank you so much for joining us. So what do you make of what you just heard from Jerome Powell? Can this latest rate hike rein in inflation?
So just to give you a sense of what the Fed has basically been trying to do and how aggressive it has been. So that benchmark rate, which was hovering somewhere around 0 in March, is right now in a band of 2.25 to 2.5. So that just, reflects how aggressive the Federal Reserve has been. For context, the kind of move that we've seen between March and July is the sort of move that we saw between 2015 and 2018. So make no mistake, the Fed is trying its best to rein in inflation that is at multi-decade highs. The question really has been whether the Fed would be able to properly navigate this fine line of bringing inflation down without necessarily tilting the economy into a slowdown or a recession. I think that has been the major question. So we've seen a 150 basis points hike in the last 2 months, which is, really highly unprecedented. We haven't seen that kind of aggression, since the Fed started using, this rate as a monetary policy tool. So it just tells you how strongly the Fed is taking inflation. Key question again is whether it will be able to rein in inflation without tilting the economy into a slowdown or a recession.
Thanks. And look, we're about to ask you about Meta. We've had you on our technology segment, which airs 3 p.m. West African time on Fridays, so we look at technology. Meta earnings disappointed Wall Street. What do you make of the results?
Well, I think, Meta is not alone here, really. So this drop is basically on the back of the fact that we're seeing, ad revs drop significantly. And ads contributes quite a sizable chunk to total revenue. For Google, ads contribute over 80% to revenue. For Facebook, it contributes well over 90%. So once there is competition or, a slowdown in that area, it tends to have a, negative impact on overall, revenue. So with the slowdown in the economy, with stiff competition coming from, guys like TikTok, it only just, alludes to the fact that, Meta would certainly struggle in that area for maybe another year or so. It's also basically decided that it would, slow down on hiring as well to try and ensure that, it reins costs, as well. So these are issues that affect, broad technology companies. Meta certainly is not alone, in this area.
Thanks. Now, the company that's doing well, on the other hand, this is oil and gas, Shell, bumper profits, I guess. Was this expected considering where oil prices are?
Oh, absolutely. I mean, we've seen crude oil prices, rise strongly over the last year or so. I mean, Year to date, crude oil prices are up about 36%, year on year, up about 43%. So the strong earnings growth for oil majors really is not unexpected. And for Shell, this is in spite of, lower oil volumes. But of course, we saw, stronger refining margins. We saw stronger performance from its power and energy businesses. So all of these basically contributed to the sort of strong profit that we've seen for Shell. And obviously, it's also doing that, $6 billion in share buyback, just giving back to shareholders, So it just tells us that, the oil majors are on a really decent footing on the back of the strong rally that we've seen in crude oil prices. So, for the oil majors, it really remains to be seen how these performance will pan out going forward. It all really rests on, the trajectory for crude oil prices going forward.
Can I quickly, just a quick follow-up on the Shell record profits and all, I think Total Energies as well. Biden, for instance, is calling for a windfall profit tax on energy majors. I think it's doing the same thing in the United Kingdom. I think Boris Johnson was talking about that. Do these type of profits, them recording these profits, does that amplify that call for windfall taxes on them?
Well, I think, it probably does. But at the end of the day, you want to look at guys like Total and Shell are also investing, very heavily in renewables. I think all of this also stems from, the fact that, the administration in the White House is also pushing for, green energy for renewables. And they feel they need to, really come down heavy in terms of taxes on the oil majors. But again, you have to look at it from the perspective of the fact that these guys are also investing quite heavily in that energy transition mantra, So, but again, as their profits rise, most certainly the calls for increased taxes will certainly get louder.
Thanks, Efosa. Just a couple minutes to go. What do you make of China's plans to boost its struggling real estate sector?
I think it's a laudable one. It's something that the government needed to actually step in to do. The real estate sector accounts for about a quarter of China's GDP. And it's been embroiled in a lot of trouble over the last couple of months. Started with the whole Evergrande issue late last year. We saw a couple of other real estate developers defaulting this year. Shimao, for instance. We also saw some very concerning developments, in the Chinese real estate sector where, buyers are refusing to pay their monthly mortgages. We are now even seeing situations where developers are wooing buyers with cars and pigs and all that. It just tells you how challenged that sector is. And considering the fact that it contributes a quarter to Chinese GDP, it only makes sense that the Chinese government steps in at this point to do something. I think the question is around whether the 1 trillion yuan would be enough. And the estimation is that it will certainly not be enough. The woes of the Chinese developers goes beyond the $1 trillion. That's just 1 trillion yuan, which is just under $150 billion. Evergrande alone has debt of over $300 billion. This is a move in the right direction. Whether it would, resolve the entire real estate issue that China is going through right now really remains to be seen. And this obviously has implications for Chinese growth, this year. So I would expect that, the government will move very quickly on this front and probably even, do a bit more to try and assuage the real estate issues within the economy to ensure that, the economy is on a path of sustainable growth going forward.
Great stuff. Efosa Aluyi, Head of Investments, Sankofa, thank you so much for joining us to take us through those headlines. Appreciate your time.